Okay, so next we'll learn about how to do revenue recognition. So when do we recognize a revenue? First of all, if you are doing a sale to a client, there is generally a contract between you and your client. I'm not talking about you walking into a store and buying a product. That is also kind of a contract. It's a virtual contract. It's a verbal contract. It's not a physical contract. Contract is you go to a store, you like a product, you negotiate the price if that's possible, and then the um, shop owner supplies that product to you, and once you make the payment, that product becomes yours. So now that ownership is with you. So this is a verbal contract that both of you have, right? For that you made the payment. So this is one type of contract, which is kind of cash and carry. You go to a store, you like a product, you make the payment on that, you get the product, now that product is yours. And the shop owner will record revenue against that. He has done sales, so he will record revenue. Okay. Second type of contract is where you walk into a store, say you have your own business and you want to buy, say, 10 laptops. And this is a regular contract that you have with that particular shopkeeper. So here there is a contract between you and the shop owner, saying he will supply you 10 laptops. So the contract is he will supply you, and the main performance obligation is he will have to give the ownership, the risk of all those products to you. For that you will decide on what is the price, right? And the price can be for different performance obligations. So whenever the supplier is giving you the product, the shop owner is giving you the product, that is his performance obligation. So first one is there should be a contract between the buyer and the seller. Second point is there has to be a performance obligation. Performance obligation is what is it that the seller has to do to make sure that the product has been given to the customer. Whether you physically receive it or whether the supplier transports that. If you are an exporter or an importer, whether the supplier is maybe docking that into the port. So what is your performance obligation? And on that we'll have to recognize what is the transaction price. So there is a possibility that one sale can have two performance obligations. Is that possible? Can one sale can have two performance obligations? So say if you buy a washing machine, you go to Reliance Digital, you buy a washing machine. So first performance obligation is they delivering you the washing machine to your residence. What is the second performance obligation? Installing, right? Because you'll have to connect the pipe to the tap. They'll have to show you how to use it, because if you are buying that for the first time or you bought a different brand which is little technical for you to understand how to use it, so they'll do a demo of how to use it and all of those things. So there are two performance obligations, right? So one is to give you the ownership of the product and one is to install. I'm just giving you an example. Different kinds of contracts can have different kinds of performance obligation, right? So we need to basically differentiate between various performance obligations and then transaction price for each. So only when all these steps are basically done between the buyer and the seller, we will record something as a revenue. In here, did I anywhere mention that you received cash? No. The only thing is the seller has to do his performance obligation. That performance obligation can be to transfer the risk of the product to the customer, can be to deliver that particular product to the customer's residence, or can be something that the customer has asked you to do. Okay. So again, coming back to our washing machine installments. So when you buy a washing machine, the price that you pay, say 15-20,000, I don't know what is the cost, right? So do you pay for installation separately, or is it part of the washing machine?
It is part of the washing machine.
It is part of the cost of the washing machine. So here the transaction price is the same. Performance obligation is 2, but the transaction price is 1. Okay. But let's think of another example wherein you have your own building and you install the lift. So you buy the lift, they will install the lift, 1 transaction price, and the transaction is completed. Apart from that, you want them to maintain the lift. If anything breaks down, you will call them, they'll repair it, something like that. So you'll have a second contract with them for maintenance. For this, they'll charge you separately. So here the transaction price are 2. One is for the lift that you bought and the installation, because we told that installation is part of the product. We'll assume it even here, the lift buying and the installation is part of the lift. But the maintenance part of it is a separate contract that we are having. So we are having 2 contracts now with the person from whom we have bought the lift. Which brand of the lift would you prefer? Any brand that you know?
No,
Say.
because we are not using it.
Okay, let's say it is Johnson lift, or we have Schneider, various other brands of lift. So between you, so let's be optimistic that you will have your own building someday. Yeah, you will have a contract with Johnson. One contract will be to come and install the lift that you want, how many ever the capacity, how big, small the lift is, and also you will have a contract with them for the next 2 years, 5 years, 10 years, how many years you want, that they'll have to regularly come and do the maintenance of your lift. This can be one kind of contract. Or whenever you buy, say, a laptop or a phone or an iPad or any electronic product, they give you warranty with that. And sometimes they tell you that if you want to extend your warranty by another 2 years, you should pay this extra cost. So again, here there are 2 performance obligations. The product with the inbuilt warranty, and if at all you want to extend your warranty. If you extend the warranty for that extra years, they will help you with any kind of repair, replacement of that particular product. Whatever are the terms and conditions of those warranty products, whatever are the terms and conditions, right? Can you think of any other product which has 2 performance obligations with 2 different transaction prices?
AC.
Yeah, very good example. So you buy the automobiles. Yeah, we can say that first, say 10 services they'll give you free of cost, and then you'll have to pay them separately. But that is not a contract. So whenever you go to service for them, they'll service it and they'll give it to you. But when you buy the automobile, there is no contract that they'll have to do the maintenance. AC also works the same way. You'll buy it, they'll install it. But again, for the maintenance, we don't have maintenance contract like we have for lift. Whenever there is a breakdown, we'll call them, because that maintenance is not that regular. But lift maintenance is something that we need on a regular basis. Escalators. That again on a need basis, not regular maintenance. I'm not sure if there's a regular maintenance. Maybe if you have your own mall, Then you
Yes.
might have
Regular.
regular maintenance of all the escalators, all the lifts that you have. So maybe you will have one contract who will install all your escalators and lifts and all of this, and the other contract will be for a regular maintenance of all of it together. Possible, right? So again, it depends from business to business, the contract to contract, the product that you're buying, and the kind of services that you're looking for, right? Another thing is, say if you uh, say buy a software for your business, right? One contract is for the company to install that software in your laptop or desktop, whatever you are using. Laptop, desktop is very outdated now, right? And the other contract, again, this is a virtual or verbal contract, that whatever are the updates they'll have to give you on a regular basis, like you have an Android or an Apple product, regularly you will have some updates that you'll have to install, and then you'll see some new features that come up or something like that. So this can be one of the contract, right? One is for you to buy the product, they will charge you some fees, but this is like an add-on. Are you paying anything for the updates, right? Other contract can be that you bought some exclusive say application or from a particular customer, from a particular seller. So for that you will pay something, and for the add-ons, which is latest updates and all, you might pay something else. So again, it's based on the kind of contract that you have between buyer and seller, right? So do we understand now by what is performance obligation? Do we understand by what is the transaction price? And also, do we understand that one sale or one contract can have multiple performance obligations and multiple transaction prices attached to that? So these are the day-to-day things that we do, but we don't basically pay attention to all of those things. So now through financial, so this is for our day-to-day operations, but business houses will have a lot of different contracts with them, right? The kind of product that they are selling, different contracts that they sell, or the kind of products that they are buying, say machinery and all. So even there they might have two different contracts. One is to install the machinery, and then there can be another contract for regular maintenance and repairs of those machineries, right? To oil it on a regular basis, to see if there is some breakdown that has happened, right? So based on this, based on you basically fulfilling all of these 5 pointers, only then you will record something called as a revenue on your income statement. Okay, so now if we talk about revenue, we can record it in so there are three different ways in which we basically get revenue. One is on cash sales, right? You go to a store, the seller makes a sale, you walk out of the store by taking the ownership of the product for which you have paid. One is on credit sales, right, wherein you have a contract with the seller that he will supply you say 10 units of laptop for your new business, but you will make the payment for that after say 30 days or 60 days, right? And the other one is you have made some advance payment. So for the contract that you've given to the seller that to deliver you some 10 units of laptop, he will ask you, sir, make me some advance payment so that I'm sure that you will buy this from me, right? So these are the three different ways in which the seller is basically getting revenue, is doing sales. But does all of these impact your income statement, balance sheet and cash flow? Okay, so cash sales, does it impact your income statement? Yes, you will record that as sales. So you will record something called as sales or revenue. Does it impact your balance sheet?
Yes, ma'am. Yes, ma'am.
Yes. How?
Because if we sell any product, we get the income and we can show in balance.
Where? Again, tell me the line item.
Cash
cash. So in balance sheet we'll record cash. In cash flow statement, will it impact cash flow statement? Yes. Again, cash inflow from operating activity. So we'll record that as cash inflow. So all of these are CFOs. All of these will be CFOs. Credit sales, wherein you have made the sale but you have not received cash against that. Again, in income, does it impact income statement? Yes, we will record as revenue. Balance, does it impact balance sheet?
Yes.
What will we record?
Current receivables.
Accounts receivables, we will record AR, so I am just writing the short form AR. Does it impact CFO, cash flow?
No.
No, because
Cash isn't received.
we have not received the cash yet, so there is no impact. For the advance payment, which we also called as, let's call it as advance payment only. Does it impact income statement?
No.
No, because we've still not done our performance obligation. So this has no impact. Does it impact our balance sheet?
Yes.
What do we record? And where?
Not before only we said no.
Unearned revenue.
Unearned revenue. Where?
Current liabilities.
Current liabilities we will record. Unearned revenue. Does it impact cash flow?
Yes, no.
Yes, why?
We have paid it.
Paid or received?
Yes, we are.
This is all from the point of view of the seller. Seller. So he has received cash,
Yeah, received.
right? So again it is a cash inflow in CFO. So do we understand all of these different ways of sales happening, right? And this credit sales is called, so all of it actually is done based on accrual accounting. Accrual accounting basically means is you will record revenue only when you have earned it. When you have finished all of these performance obligations, you will record that as revenue, and that is called as accrual accounting. First one is simple cash and carry. Credit sales is you have earned the revenue but you have still not received the cash. So you will record the revenue because you have earned it. When you receive advance payment, you have still not earned the revenue. You have not finished your performance obligation of supplying 10 laptops to your client, right? So even here you will not record revenue because you have still not earned it. Accrual accounting basically means that you will record the revenue only when you have earned it, and not when you have received the cash or not received the cash. Even if you have received the cash in advance and you have still not finished the performance obligation, you will not record the revenue, right? And even when you have not received the cash, you have finished the performance obligation, you will still record the revenue. So these are the three different ways in which revenue is impacted through accrual accounting, right? So next, let's do another topic. So we are done with revenue recognition. Now we will do expense recognition. So expenses, what's the various kind of expenses a business can have? Again, let's take the same example of laptop sales that he is doing. So what are the various expenses that they will have?
Transportation, salary, rent.
So all those are your basic expenses that you.
Okay.
So all of these expenses you will record as incurred as in when you will incur those expenses, you will record them. What are the other kind of expenses that he can have?
Raw
Tax.
materials.
Okay.
Tax.
Okay, even all those are you will record as you incur it.
Okay.
Right? So there are two other kinds of ways of recording expenses. One is as per matching principle and one is as per capitalization. Right? So talking about matching principle, say the Reliance Digital owner buys laptop and then he sells it, right? So say he does multiple purchases. He'll buy in Jan, he'll buy in say again in April, then again he buys it in say August, and then again he does some buying in December. So all these are the purchases that he has done, right? And maybe the one he's got it in, so where will we record the cost of all these purchases?
Income statement.
Where?
Expenses.
What expense?
Direct expenses.
What is the line item called? From income statement. So he's saying all these purchases will record as part of income statement. Where will we record in income statement? Which line item?
Fixed cost.
Did I make you write anything as fixed cost when we did income statement? Okay, let's park that question. Say whatever I've got in January, I've sold this. So now where will I record this cost?
Which cost?
So I got laptops. Say worth each laptop costed me say 35,000, and I've sold these laptops at say 50,000. So where will I record 50,000?
Sales.
35,000
COGS.
COGS, right? So once you purchase it, you will record that as,
COGS.
once you purchase, you will record it as COGS. Only when you sell it, you will record that as COGS, right? So whatever purchases that you've done as per matching principle, right? If you have earned some revenue against that, so you need to match. If you have recording an income statement, we will record sales and COGS based on the number of units that you've sold. It's not based on the number of units we have purchased. So the number of units will be same in both sales and COGS, right? 100 and 100. So if the sales amount is 20 and say if you bought it at 15. But when did you buy these is not the question here, right? So as per matching principle, whatever you've sold, only whatever revenue you've earned, only against that you can record whatever you've sold. Purchases doesn't matter. So again coming back to this question, so Jan, only if you have sold it you will record that as COGS. Before selling it, where will you record it? Inventory. Record that as inventory, right? You will not record that as COGS because unless and until you don't sell it, unless and until you have not recognized any revenue against that, you will not record its cost against that. So this is as per matching principle. Again, if something that you bought in December, considering our financial year is from Jan to December, right? And we have sold this in next year February. So the cost of this we will record in next year February. Until then it will lie as part of our
Inventory.
inventory as ending inventory in our balance sheet. So this is one example for our matching principle. And another example can be whenever you do any sales against that, against sales on credit, right? If they are not able to pay that, what do we record that as?
Right.
Bad debts, right? And if the company has made these sales of laptops, with that company is giving some warranty. So which is a cost from the company's perspective, if at all any breakdown, any repair comes, right? So all of these, so there are two kinds of expenses. One is on credit sales, you have bad debts, and on electronics you have warranty. So both of these expenses, when do you incur? The year that you have made sale, the month you have made sale, or in future? Both of these are kind of expenses, cost to the company, right? If I have made credit sales, I don't receive money against that, that's a cost to me. That's a loss to me,
Okay.
right? So when do we incur these losses?
Future.
In future, not today. But as per matching principle, it tells you that whenever you've recorded revenue against the sales that you've made, in the same year you will have to record provision for bad debts, provision for warranty, as per matching principle. So if you've recorded revenue of say 1 lakh, whatever are the associated costs pertaining to those revenue, cost of goods sold, cost of bad debts, cost of warranty, though you might incur these costs in future, as per matching principle you will have to record that in the year when you have recorded revenue against that. Am I clear? Yeah, as per matching principle. So you're basically matching with your revenue and the associated expenses that you have incurred or you might incur. Both the expenses you will record in the same financial year. Okay, so this is what matching principle is all about. Next one is capitalization. So whenever you buy say a machinery for your business, where do you record that expense? Asset. Why not as a expense in the income statement? Why not in the income statement? I say
Because we are doing that not like expenses, we are buying that like investment.
why?
It
Because
will
that
generate income in future.
It will generate economic benefits in the future. So any expense that you have incurred which will give you economic benefits over a period of time, right? So when you buy a machinery, say you bought it at 20,000, that will, and we will have to estimate what is its useful life. So we will record that as an asset in the income statement, which we call it as capitalization. Any expense, if we record that as an asset and the balance sheet as an investment, we call that as capitalization of your expense. We call that as capital expense, right? And how do we show that expense in our income statement over those period of times?
depreciation.
Depreciation. We also were basically spreading across that cost for how many years we will be using that machinery, and by using that machinery, what is the revenue that we are basically getting out of that usage of that machinery, right? So whenever you record an expense as an asset, that is called as a capitalization of expense. So this is another way that we record our expense in our balance sheet. So one is expense as incurred, like your advertising expense, your salary expenses, your rent, your electricity, all of those are expense as incurred. Matching principle is whatever is the cost associated with the revenue that you have generated that year, all of those you will record in the same year, even though you've still not incurred those expenses, right? Capitalization is whenever you record an expense which will give you economic benefit over a period of time, you will record that expense as an asset on the balance sheet and spread across its cost over a period of time through depreciation or amortization. Are we clear? 3 principles of expense recognition, right? So today we learned majorly about revenue recognition and expense recognition. So when we actually start with the curriculum, we'll do examples of all of these things and try and learn this through numbers rather than just theoretically. But theoretically, intuitively, is it making sense? Yeah? Take this time.